Bitcoin hit $103,000 on December 5th. Within 48 hours, it crashed to $94,000 while destroying $350 billion in cryptocurrency market value during what should have been the Christmas rally season. This represents the largest single crypto wealth destruction event in history, while proving cryptocurrency has no intrinsic value beyond pure speculation. This is Bitcoin's Christmas crash, and it reveals everything. Let me show you exactly what this crash means for cryptocurrency markets. Let me walk you through the mathematical proof that crypto represents worthless speculation disguised as investment. And let me explain why this Christmas collapse signals the beginning of systematic cryptocurrency destruction that will eliminate trillion-dollar market capitalizations built on nothing but hype and manipulation. Because when you understand the crash mechanics, when you see the liquidity problems, when you recognize the regulatory acceleration, you realize this is not temporary volatility. This is systematic value destruction of assets that never had legitimate economic foundation. The Bitcoin crash is not market correction. The Bitcoin crash is value recognition. Every speculative bubble in history followed identical patterns through euphoric price peaks that attracted maximum public participation before systematic collapse eliminated accumulated wealth. The dot-com bubble peaked in March 2000 before destroying $4 trillion in market value. The housing bubble peaked in 2006 before eliminating $8 trillion in household wealth. Bitcoin's $103,000 peak represents identical bubble characteristics through price appreciation, disconnected from underlying economic value, while creating wealth illusions that systematic selling pressure eliminates through mathematical inevitability. The crash timeline reveals systematic institutional liquidation rather than retail panic selling that suggests coordinated profit-taking by sophisticated investors who understood timing better than public participants buying at peak prices. December 5th marked Bitcoin's all-time high at $103,047 during Asian trading sessions, when liquidity remains limited and price manipulation becomes easier through concentrated buying pressure. December 6th began systematic selling through European markets, while institutional investors liquidated positions accumulated during previous months when Bitcoin traded below $80,000, creating 50% profit margins. December 7th accelerated liquidation through American market sessions, while exchange-traded fund outflows exceeded $2 billion in single-day redemptions that forced systematic Bitcoin selling to meet investor withdrawal demands. The 48-hour crash eliminated $9,000 in Bitcoin value, representing 8.7% decline that triggered cascade liquidation through leveraged positions and derivative contracts requiring additional selling pressure. Cryptocurrency market capitalization declined from $3.2 trillion to $2.85 trillion, while alternative cryptocurrencies experienced larger percentage declines than Bitcoin, indicating systematic speculation deflation across entire crypto ecosystem. The exchange liquidity crisis became apparent through withdrawal delays and processing restrictions that indicated insufficient cryptocurrency reserves to meet customer redemption demands during panic selling periods. Binance implemented temporary withdrawal limitations while citing system maintenance despite no technical issues during normal trading periods, indicating liquidity management rather than operational problems. Coinbase experienced systematic delays in cryptocurrency transfers, while customer service responses acknowledged processing backlogs that coincided with peak selling pressure rather than routine system updates. Kraken suspended certain cryptocurrency trading pairs while implementing enhanced verification requirements that reduced trading volume and limited customer access during critical selling periods. The Tether stablecoin crisis revealed systematic cryptocurrency market infrastructure problems through price deviation from $1 parity that indicates insufficient dollar reserves backing Tether issuance. Tether traded as low as 99.5 cents per dollar during peak selling pressure, while creating systematic arbitrage opportunities that arbitrageurs could not fully exploit due to exchange liquidity limitations. USDC stablecoin faced similar pressure while trading below 99.8 cents, indicating systematic dollar shortage across cryptocurrency ecosystem when users attempted converting cryptocurrencies to dollar-denominated stablecoins. The stablecoin stress test revealed cryptocurrency market dependence on dollar reserves that may not exist in sufficient quantities to support market capitalizations, exceeding $2.8 trillion during systematic liquidation periods. Institutional investor losses reached unprecedented levels through direct cryptocurrency holdings and cryptocurrency-related stock investments that magnified portfolio exposure beyond direct cryptocurrency ownership. MicroStrategy Corporation holds approximately 190,000 Bitcoin purchased at average cost of $36,000, while current market value represents significant unrealized gains despite recent price decline. Tesla Corporation maintains Bitcoin holdings worth approximately $2 billion at current prices, while facing quarterly earnings pressure from cryptocurrency value fluctuations that affect financial statement presentation. Grayscale Bitcoin Trust trades at significant discount to underlying Bitcoin holdings, while indicating institutional investor preference for liquidity over cryptocurrency exposure during volatile market conditions. The regulatory acceleration became apparent through coordinated enforcement actions and policy announcements that coincided with Bitcoin price peak, suggesting deliberate timing to maximize market impact. European Union's markets and crypto assets regulation implementation creates systematic compliance costs while limiting cryptocurrency marketing and operational flexibility for European-based cryptocurrency businesses and exchanges. United States Securities and Exchange Commission increased enforcement activity through cryptocurrency-related lawsuits and regulatory actions that create legal uncertainty and operational costs for American cryptocurrency businesses. Federal Reserve officials intensified criticism of cryptocurrency speculation while suggesting central bank digital currency development that would eliminate private cryptocurrency competitive advantages. Bank for International Settlements published research questioning cryptocurrency economic utility while recommending international regulatory coordination that could limit cryptocurrency adoption and trading volume. The energy cost analysis reveals Bitcoin mining unprofitability below $85,000 while creating systematic selling pressure for mining operations that must liquidate Bitcoin to cover operational expenses. Bitcoin mining difficulty adjustments lag price movements while miners face immediate cash flow pressure from electricity costs, equipment expenses, and facility maintenance that require dollar payments rather than Bitcoin retention. Mining operation bankruptcy accelerated during previous crypto bear markets while creating additional Bitcoin selling pressure as failed mining companies liquidate cryptocurrency holdings to satisfy creditor obligations. Environmental criticism increased through academic research and policy advocacy that questions Bitcoin energy consumption, sustainability, while creating political pressure for regulatory restrictions on cryptocurrency mining operations. The mathematical analysis reveals Bitcoin's intrinsic value equals zero, while market price represents pure speculation based on expectations that other investors will pay higher prices in future periods. Bitcoin generates no cash flows, pays no dividends, creates no economic output, and provides no productive utility beyond speculative trading that depends entirely on finding buyers willing to pay higher prices. Traditional asset valuation methods cannot apply to Bitcoin because no underlying economic activity supports market capitalization, while price appreciation depends solely on continued buyer enthusiasm rather than fundamental value creation. Cryptocurrency? Market capitalization exceeds many national economies while representing no productive economic activity that justifies wealth accumulation through cryptocurrency ownership rather than productive investment or business creation. The comparison to other speculative bubbles reveals Bitcoin exhibits identical characteristics to historical wealth destruction events while lacking any economic foundation that previous bubbles at least claimed to possess. Tulip bulb speculation during 17th century Netherlands created temporary wealth through price appreciation unrelated to tulip cultivation value, while systematic collapse eliminated accumulated speculation gains within months. South Sea company speculation during 18th century Britain created enormous paper wealth through stock price manipulation, while underlying business operations generated insufficient revenue to justify market valuations. Internet stock speculation during late 20th century America created trillions in market value through companies with minimal revenues, while systematic collapse eliminated wealth when earnings failed to justify valuations. Bitcoin speculation creates similar wealth illusions, while completely lacking any business operations, revenue generation, or economic utility that previous speculative bubbles claimed as justification for price appreciation. The international implications include systematic wealth destruction across global cryptocurrency markets, while creating negative economic effects through reduced consumer spending and investment capacity. Japanese cryptocurrency investors face significant losses through Bitcoin price decline, while yen weakness increases cryptocurrency costs for Japanese purchasers who face double currency exposure during market volatility. South Korean cryptocurrency markets experience systematic selling pressure, while government regulatory uncertainty creates additional volatility beyond global cryptocurrency market trends, affecting domestic investor confidence. Chinese cryptocurrency investors continue trading through offshore exchanges while facing regulatory restrictions and legal uncertainties that limit ability to recover losses through traditional investment protection mechanisms. European cryptocurrency investors face additional compliance costs and regulatory restrictions. So while markets and crypto assets implementation creates operational complexity for cryptocurrency transactions and holdings management. The psychological factors driving cryptocurrency speculation include social media influence, celebrity endorsements, and fear of missing out psychology that creates systematic buying pressure unrelated to economic analysis or investment merit evaluation. Social media platforms amplify cryptocurrency promotion through influencer marketing and viral content while creating false impression that cryptocurrency investment represents sophisticated financial strategy rather than speculative gambling. Celebrity endorsements provide credibility for cryptocurrency speculation, while public figures lack expertise in financial analysis or understanding of cryptocurrency economic utility beyond promotional compensation arrangements. Mainstream media coverage emphasizes price appreciation stories while minimizing risk analysis and economic criticism that would provide balanced perspective on cryptocurrency speculation dangers and wealth destruction potential. The recovery probability analysis suggests cryptocurrency markets face systematic long-term decline while speculative enthusiasm cannot sustain market capitalizations lacking economic foundation or productive utility. Historical speculative bubble analysis shows systematic wealth destruction continues for years after initial crash, while market sentiment shifts from euphoria to despair through extended bear market periods. Cryptocurrency markets lack fundamental economic supports that enabled recovery from traditional asset market declines while depending entirely on speculative sentiment that becomes negative after significant wealth destruction events. Regulatory pressure will increase systematically, while governments recognize cryptocurrency markets create financial instability without corresponding economic benefits that justify regulatory accommodation or protection. The investment alternative analysis reveals traditional assets provide superior long-term wealth creation, while avoiding speculative risks that characterize cryptocurrency markets during both bull and bear market cycles. Stock market investments provide ownership claims on productive businesses, while dividend payments and earnings growth create wealth through economic value creation, rather than speculative price appreciation. Real estate investment provides ownership of productive assets, while rental income and utility value create economic foundation for price appreciation beyond pure speculation on future buyer sentiment. Bond investments provide predictable income streams, while government and corporate debt service creates economic basis for investment value that does not depend on speculative market sentiment for return generation. Commodity investments provide exposure to essential economic resources, while supply and demand fundamentals create price discovery mechanisms based on productive economic use rather than speculative trading activity. The consumer protection implications include systematic wealth destruction affecting millions of cryptocurrency investors, while regulatory agencies provide limited recourse for speculation losses disguised as legitimate investment opportunities. Cryptocurrency exchanges operate with minimal consumer protection, while bankruptcy proceedings typically result in complete loss of customer cryptocurrency holdings without deposit insurance or investor protection mechanisms. Cryptocurrency taxation creates additional losses, while realized gains face ordinary income tax rates in many jurisdictions, despite speculative nature of cryptocurrency appreciation unrelated to productive economic activity. Estate planning complications arise through cryptocurrency holdings, while inheritance tax obligations and technical complexities create additional costs and legal uncertainties for beneficiaries and estate administrators. The technological analysis reveals cryptocurrency infrastructure limitations, while transaction processing capacity, energy consumption, and network security costs prevent cryptocurrency adoption for legitimate economic purposes. Bitcoin transaction processing capacity remains limited to 7 transactions per second, while payment processing networks handle thousands of transactions per second, creating practical utility limitations for cryptocurrency adoption. Lightning Network solutions create additional complexity while requiring technical expertise and infrastructure investment that prevents mainstream adoption for routine payment processing or commercial transactions. Energy consumption for Bitcoin mining exceeds many national electricity usage while creating environmental concerns that prevent institutional adoption and regulatory approval for sustainable investment portfolios. Network security depends on continued mining participation, while profitability challenges during low price periods create systematic security risks through reduced mining capacity and potential centralization concerns. The final mathematical conclusion proves Bitcoin represents pure speculation without economic foundation, while Christmas crash demonstrates systematic value destruction that will continue until market capitalization reflects intrinsic value of zero. $103,000 Bitcoin price represented peak speculation, while $9,000 48-hour decline indicates beginning of systematic wealth destruction that eliminates accumulated paper gains. $350 billion market capitalization destruction during Christmas period reveals speculative nature of cryptocurrency wealth, while systematic selling pressure overwhelms artificial buying support. Cryptocurrency markets face inevitable systematic decline while lacking economic foundations that support legitimate asset valuations, creating wealth destruction that affects millions of speculative investors globally. Bitcoin's Christmas crash proves cryptocurrency is worthless speculation. The mathematics guarantee continued decline. The wealth destruction is systematic. The intrinsic value remains zero. This is not temporary correction. This is value recognition. Bitcoin is worthless. The Christmas crash proves it. The speculation is ending. The wealth destruction has begun.